I argue that the black hole is actually opening up, which is an extremely worrying phenomenon. I think it's almost inevitable that the central banks, led by the Fed, will soon have to give up their policy of tightening and put their rate hikes on hold.
Welcome back to Breakout with Breaking Views, sponsored by PGIM. I'm Peter Thalas, I'm the global editor of Breaking Views, today in London's Canary Wharf, and I'm joined again by Edward Chancellor in the West Country. Today we're talking about central banks trying to raise interest rates. Eddie, you call the ultra-loose monetary policy that we've seen over the last decade and a half or so in the West the financial black hole. Tell us what you mean by that.
Well, 8 years ago, the then governor of the Bank of England justified the Bank of England's very low interest rates, saying that they were designed to create what he called escape velocity, which is a term that physicists use for an object to leave the gravitational pull of a planet. Now, we never got escape velocity. The economic performance of all the developed markets remained fairly depressed, and then we had COVID lockdowns, and now all mayhem. And so instead, I say that the low interest rates would more closely resemble a black hole. And what I mean by that is the black hole has an immense gravitational pull. You actually need the escape velocity required to get out of a black hole is actually the speed of light. And the reason I'm using this analogy is that people have been commentating a lot about the rises in interest rates, and they say, oh, well, we're getting interest rates back to normal level. And in a perfect world, that's what would be happening. But if you're still being sucked into this black hole, you can raise interest rates, but they don't actually, that actually the system begins to fall to pieces. And that's what I try and analyze in this.
Yeah, so you're talking about the fact that you make the point that everybody's got more debt than they did before interest rates went to very low levels. So households, governments, and corporations, right? And that seems to be the problem, is that if you start raising interest rates, those borrowers are going to have trouble with their debt. Is that right?
Well, yes, you can sort of break down the analysis into the components of GDP. So you've got households, and I use the example of British households who, over the last 40 years, have their mortgage size relative to income has gone from around 1.5 to nearly 3.5 times. So you can see that they're much more levered than mortgage holders. And that was because mortgage costs were very low. Now, British home buyers are exposed to short-term rates. You either get floating rates or short-term fixes. And the trouble is that last year you got average mortgages around 2%. And now the new 2-year rates are going up to 6%. So that's a threefold increase. And I cite a housing analyst called Neil Hudson, who says that in order to bring housing debt or mortgage levels back to their historic average levels, house prices would actually have to fall by 36%, which it would be a big deal.
So that would mean lower house prices. But what about the government? I mean, and again, you talk mainly about the UK government, although you could apply this to many other governments. I think you had this great number saying national debt has basically trebled as a proportion of GDP, 34% to about 95%. But debt service payments have fallen by nearly half over the same period. So presumably the danger is that interest rates go back up and then the cost of borrowing increases.
Yeah, I mean, it's slightly worse than that, actually, in that the Bank of England, with its quantitative easing operations, went and bought around 875 billion of government securities and and I think 20 odd billion of corporate bonds. Now, that was justified on the grounds of monetary easing, if you remember. But from a corporate finance perspective, it really involves an interest rate swap. The government, which owns the Bank of England, is swapping its fixed rate long dated bonds for short dated liabilities or loans to the Bank of England. Now, last year, the bank charged only 10 basis points on that debt, and total charge on the government debt, of the British government debt, was only 1.1% on that 95% we mentioned. Now, a House of Lords report last year, very insightful, that had Mervyn King, a former Bank of England governor, on its board. They pointed out that the British government debt is much more exposed to rises in short-term rates, and by one estimate, roughly a 1 percentage point increase in rates would lead to an increase in government debt servicing costs of nearly 1% of GDP. So, and as I point out, if the government had to borrow at its average historic rate of around 6%, then the amount of debt service payments out of income would rise fivefold. And I don't think it can do that.
Yeah. So, but we've got this situation where the central banks have, the Fed and the Bank of England and others, the ECB, have all said we're absolutely determined to crush inflation. We're going to raise rates until that happens. But at the same time, obviously, we've seen the beginning of this in the UK, but potentially we might see this elsewhere. Some cracks appearing in financial markets, things that don't work as well as they should do. So where does there's obviously a tension there, but sort of where does this lead us? Do you think? Are we stuck in the black hole as far as central banks are concerned, or do they sort of keep raising rates until something really goes wrong?
Well, last week we discussed the crash in the UK gilts market, which forced the Bank of England to intervene. And in the meantime, the Bank of England has had to come back repeatedly to try and calm the markets, and even lowering the quality of the collateral that it accepts. So I argue that a sort of the black hole is actually opening up, which is an extremely worrying phenomenon. And I think that I think it's almost inevitable that the central banks, led by the Fed, will soon have to give up their policy of tightening and put their rate hikes on hold. So I think that is the likely next development, the pivot, so to speak.
The pivot from the pivot. So we'll get sucked back in to the black hole. Yeah. Okay. It is fascinating as always. Thank you very much. And we'll talk to you again about all of this soon.
See you next week.